In today's video, I'm going to be talking all about market volatility and what you should do about it. If you've ever looked at your investment account and felt uneasy during a market drop, you are not alone. But during these times, most investors forget this. Market volatility isn't something to fear. It's something to expect. In fact, volatility is a normal and necessary part of investing. Today, we're going to break down why that is, and more importantly, what you should do when the markets do get choppy. What is market volatility? Market volatility refers to how much and how quickly prices move up and down over a given period of time. So when markets are volatile, you'll see larger swings, both in gains and losses in a short time period. And while that can feel uncomfortable, it is a normal characteristic of the stock market. Volatility exists because markets are always reacting to new information. This can include things like economic data, interest rate changes, corporate earnings, geopolitical events, and investor sentiment. Markets are forward-looking, meaning that prices are adjusted based on what people think the future will hold, not just the current conditions. And because of that, there is uncertainty built into the system. And where there's uncertainty, there is volatility. Something I want to cover is the difference between volatility and risk. Volatility is the short-term movement of the market. Risk is in reference to the potential permanent loss of capital. And while volatility can feel risky in the moment, it doesn't necessarily mean that you're losing money permanently, especially if you stay invested and have a long-term plan. Looking at history, markets have always experienced periods of volatility. Despite those periods, the market has historically trended upward over the long term. The key takeaway is that short-term declines are a part of the story, but they don't define it. So what should you actually do when the market is volatile? First, don't panic. Emotional decisions are one of the biggest drivers of poor financial outcomes. Second, stay invested. Trying to time the market often leads to missing your recovery periods, which significantly impacts your long-term return. And third, stick to your plan. Your strategy should account for volatility based on your goals, time horizon, and risk tolerance. During volatile markets, investors make a few common mistakes: selling investments out of fear, moving to cash and waiting for the right time, overreacting to short-term headlines, checking your portfolio too frequently. These reactions can turn temporary volatility into permanent setbacks. A helpful way to think about volatility is this: it's the price you pay for long-term growth. Without volatility, there would be little to no return potential. Accepting that ups and downs are a part of the process can help you look at the bigger picture. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.